All right, good morning, folks. I'm not sure what's going on with YouTube, but you probably noticed there's a lot of issues with the volume during my live streams. You probably noticed that the live stream that I was doing last night was abruptly stopped. I didn't stop it. I actually spoke for another 35 minutes or so and wasn't aware that the stream had stopped. So this video is more or less a continuation of last night's live stream. I had a good rhythm last night, and I was covering a lot of things that I was very pleased with in the presentation, but unfortunately the stream was abruptly cut off. I don't know why it did it, but I find it odd that I'm having a lot of trouble broadcasting these things, so I'm going to do it as a pre-recorded video and see how that works out. I started the stream last night kind of like reminding you to watch yesterday's live stream, and I went through several things about narrative, what I wanted to see, what I didn't want to see for the opening bell, and how that daily range would be delivered or implemented. This is our regular trading hours chart. 9:30 opening bell yesterday, 4:14 settlement previous day, regular trading hours, opening range gap. Okay, so if we don't look at the annotations, it can be rather aimless looking at price action. So I'm going to add the annotations. Okay, you can see all these things here. And yesterday in the live stream during the morning session, I mentioned one of the things about the narrative of the opening bell before I left the live stream. It was not 9:30, so I didn't have the 9:30 opening price. I didn't know what the full opening range gap would be and where its consequent encroachment would be. So as it is, you can see that this is the midpoint or consequent encroachment of the opening range gap. Gap low, previous day's settlement at 4:14. Opening price at 9:30. That's your gap. Upper quadrant, consequent encroachment, lower quadrant, and the low. I mentioned 600, 20,600. If it was to trade up to that yesterday before we got to the opening bell at 9:30, then I felt that we would trade to these levels here on the Judas and then sell off. But I said if we didn't do a run above 600, what will happen is it'll just sell off and go to consequent encroachment of the opening range gap, or as much as 3/4. Best case scenario would be full gap closure, but these are the two levels I talked about because we didn't go above 20,600. You're welcome to go back and listen to the live stream yesterday. It's not long, it's fairly short, and you'll hear me outline very specific scenarios that I would anticipate and utilize. So I'm going to go into electronic trading hours. All right, so here's electronic trading hours, and I counseled you last year on Twitter in my Twitter Spaces. I taught a concept of first presented fair value gap on Monday. So the fair value gap that forms after the opening bell at 9:30 Eastern Time on Monday, that first 1 minute fair value gap, you need to extend that throughout the entirety of the week because it's going to give you intel that you would never notice before. And that was the basis for me looking at the 20,600 level, because if we were going to trade up to and above that 20,600, then it most likely will come back down and touch that Monday first presented fair value gap and use it as an inversion fair value gap, and that would be the catalyst for the Judas swing up into these levels as I indicated yesterday in the live stream. But because it didn't do that, I said that we would sell off and attack the sell side below here, trade into this gap, and then consequent encroachment or lower quadrant of the opening range gap. Best case, full gap closure. So you can see how we used the sell off in here. This was our first presented fair value gap, this candlestick right there. It's at 9:33. There is no gap prior to that until you get to 930, and 930 is not the candle that you use for first presented fair value gap. So you can't use the 930 candle. I'm going to talk about this over here in a moment, but I want you to see how we traded down through consequent correction of the opening range gap, failed to get to the lower quadrant level, came back up, traded into the gap that I mentioned would be impactful, and that acted as inversion fair value gap here, traded back down, used the consequent encroachment level here as a institutional order flow entry drill, short, trading below the short-term swing low where sell side would be, trading to the lower quadrant of the opening range gap. Back to consequent encroachment, purple line, breaking down fair value gap, sell off here, target the relative equal lows. Each time it makes a new lower low, you'd be taking a partial. It didn't take the low out here, but that's okay. And Caleb would have used this right there as his short, targeting each one of these lows as a potential closure on his trade, using this as a draw. At 11 o'clock, he'd have to stop trading. And there it is. Between 10:30 and 11:30, that is the lunchtime macro. The algorithm will start turning back against the positions that are on side. That means if the market's been dropping, as you can see here, it's going to go back through where all the swing highs are, and it's going to aim for the buy side liquidity. It does not know how many orders are sitting above it. You don't need your book map or anything like that. It's just simply going to go to those highs. Okay. The market rallies up, trades into a fair value gap here and a bullish breaker. That's your breaker right there. Trades to it there, rallies, fair value gap there. That's an entry. That's an entry, institutional order flow entry drill there. Rallies, comes back to the consequent encroachment or midpoint of the opening range gap, that purple level. It accumulates around that, rallies, order block, runs right into first presented fair value gap. That's that pink box here. But if I take that away, just know that it's trading up into that and then failing to get to its consequent encroachment level, which is this dotted line here, and then falls out of bed and then works lower back down to consequent encroachment. I'm going to take the first presented fair value gap off for a second, and I'll remind you that yesterday during the live stream at 8:30, I was drawing your attention to both of these volume imbalances. We trade up into the higher one perfectly. Right to consequent encroachment. But notice the bodies are staying inside the lower volume imbalance. That's not random. Okay, so the market trades up into our first presented fair value gap. It's high, but it's also consequent encroachment of the higher volume imbalance I gave you yesterday during the live stream. The bodies are staying inside the lower volume imbalance. So is that indicating bullishness or bearishness? It's bearishness. So it breaks lower, comes back up into consequent encroachment of the lower volume imbalance. And they're shaded orange now because their roles are reversing and acting as a premium array. So it breaks lower and then it consolidates around that fair value gap that I mentioned that we would probably drop down into yesterday morning before it did. And it's acting as an inversion fair value gap here, treating it as a premium array here, failing to touch it there, sells off to consequent encroachment of the opening range gap. And then it uses it once more here in the afternoon between 1:30 and 2 o'clock. And sells off institutional order flow entry drill there, fair value gap there, breaks the consequent encroachment of the opening range gap down to the lower quadrant of the opening range gap, sell side below these lows, it tags it, and then it leaves the regular trading hours with these relative equal lows, which later on in Asia, you can see that they use the sell-off here down into a full gap closure there. So I want to talk to you about what I used over here in the live stream yesterday morning, where I called your attention to these two specific short-term highs on the 1 minute chart. This high here and this high here, those are relative equal highs. During the live stream, I said, see that wick that was the 8:30 news candle? This is manipulation. And I said, kind of like for a moment, disregard that. If that didn't exist on the price chart, you would just see relative equal highs right here. And one would assume that it could go up, raid these relative equal highs, and then sell back off into a discount array or trade down into the gap I outlined over here and clean up some of the sell side. Initially, if you listen to the live stream, I wanted to see that. And if that would have happened, then I would have been anticipating the market to go up into first presented fair value gap on Monday and still try to reach for these levels up here. Okay. But in context and understanding what it was I was teaching, this wick, we can use that by taking a fib, anchoring it to the high of the wick, and dropping it down to the highs, these relative equal highs. And you can see that I'm doing that here with the fib. See what I'm doing? I'm only showing the 50% level on that fib. So if I anchor it on this high, you can see the only level I'm showing is the 50%. I'm not showing the high and the low, anchoring the points of reference. You can see that there. You see that? So I'm not interested in looking at those levels. My focus was to bring your attention on the midpoint of the range between the relative equal highs to the high. That halfway point there, that's consequent encroachment of this specific wick and its range. Normally, you would see me do things like this. I'll take this off and we'll take the fib and drop it down to the body of that same candle that has that long wick. That's consequent encroachment of the entire wick. Notice it's not giving you the same piece of information that these highs here turning, rotating back down shows. So I explained as we were trading up, I said, watch this area right here. And this is my Gallow PD array. A Gallow is this. Okay, when a criminal was sentenced to be unalived, the person would be marched up the steps and stand over top of this little area here, which is a trap door. And this platform here represents these two relative equal highs. And this wick here represents the hangman's post. And the noose is right there in consequent encroachment. So in theory, this is why I named it the Gallow. When I was trading towards this wick down here, go back and listen to the live stream. My focus was right here. I said, I want to see it go up here and then fail to go higher and rotate back down lower. It does that. Notice the bodies are failing to even trade to the consequent encroachment level of that wick between its high and the relative equal highs. Now I know some of this is probably like, this is too complicated. It's really not complicated. What I'm using is the idea of these inefficiencies that are wicks, and I'm showing you exactly what the algorithm is going to refer to. And I did this live. Before it actually delivered like this, I outlined why it would do it. And the bodies are respecting the fact that it doesn't even trade on it. The wicks are allowed to go through it, but then the bodies rotate lower and trade right back down into that volume imbalance. And then they send it higher. So a Gallow is where this trapdoor springs away and the person that has their head in that noose, they fall. Well, once they put the price in its noose right there, at consequent encroachment, they drop the platform that supports it here and trades back down. That's the reason why I call it the Gallow. Okay. Proving a point yesterday that they are usable reference points that the algorithm will absolutely have an interest in booking price to. This same level, I was watching the sell-off here, and admittedly, I was distracted with my wife. She was asking me to help her do some things around the house. So I started the recording, and I managed the entry on my phone. But I was timing it as it gets right back to that price level right there, and you'll see that happening when I add the executions. Here's your candlestick where it opens and trades back up into that level right there. Okay, right there. Now, if you can see my entry, it's just a little bit away from it because it opened, jumped up there real quick, and by the time I pushed the button, it was sitting right there. But that's the premise, okay? So I was using this basically as, initially I was looking for it to trade as a premium array, which it did. It delivered perfectly. And then it traded back above it. So it left it there. Well, if you're bearish and it comes back down to that level, I can use that as a reclaimed Gallow, a reclaimed consequent encroachment of a wick, where this was a premium array. When I'm now in a bearish market condition and sell side delivery is underway, it means we're in a sell program, price is going to be delivered lower. I can use that same reference point here as a reclaimed entry point. So it's going to act just like I was expecting it over here. It reassumes that same role as a premium array. So I can enter there. And I can use a very, very, very small stop loss. And I coupled it with the fact that we traded right back to this candlestick's low. So we opened down here, immediate rebalance with a Gallow, which is this wicks, consequent encroachment, just between these two reference points here, halfway point. Now, you'll never find that in any other resource material. No other mentor is going to draw your attention to that. No other educator, no other teacher, no other trader, no other books, courses, mentorship, nothing. Nobody from the old back golden ages of technical analysis, and nobody relatively new either, but me. And I say those types of things because I get a lot of comments, and I just posted one last night. Some goober on YouTube left a comment. I have never studied with Al Brooks. Okay, I have no disrespect intended towards the man. I don't even know who he is, except for Tom Hugard mentioned him as his mentor. And people were starting to say, well, yeah, you learned from Al Brooks. So I asked Tom Hugard, who is a student of Al Brooks, I said, you see what I'm doing. I share executions with Tom Hugard in Telegram. I have had conversations with him. And I asked him, I said, do you see anything in what I'm doing as Al Brooks material? He goes, no, absolutely not. And you can go and ask him. Be respectful. Don't bother the man. Okay, but these are things that are just nonsense. And I have openly challenged anyone that is a student of Al Brooks. Find this in the Al Brooks material. Look at the live streams. Look at the things I'm teaching as a PD array. Look how I'm calling price before it goes there. Look at the aspects of time. All those things are not anything else found in people's work prior to me. And as I'm releasing new things, people are readily going out and they're writing books on Amazon because they're real fast, easily produced, and they're trying to put it in writing like it's their work. It's not their work, okay? It's mine. And that's the reason why I hold back a lot of stuff, because a lot of the details that make these things work perfectly, I hold them close, because once I put them in book format, then everybody's going to plagiarize them and they'll sound smart afterwards. But right now, everything they have is incomplete works. They're just introductions. And you can see that because I'm using them in live data. Over a live stream, I'm explaining why the market should do certain things. None of the quote-unquote ICT mentors out there that take my content and they make mentorships out of them, they will never be able to duplicate what I just showed you today. They'll never be able to do that. And it's because I have held back certain elements so they can't profit from teaching it until I have solidified it in book form. There's a lot of people that know me because I'm on YouTube. There's a lot of people that know me because my content, my mentorship videos were leaked and resold. But the community at large, globally, they're not familiar, because they if you look at what goes on, they'll say, do you use ICT or do you prefer smart money concepts or SMC? That's my concepts. I am the author of Smart Money Concept. That's me. Okay, these ideas of order blocks, that's not supply and demand, I've ripped at the shreds. Okay, I've ripped the shreds that none of the things I'm teaching you is in Wyckoff either. Just because a market goes up and then drops back down, that doesn't mean that's Wyckoff. It just means that's what price has done. It's called swing trading. Okay, in its barest form, that's it. But what are you doing inside that price swing? My PD arrays are never found in Wyckoff. Go through it, study it. I invite you to do it. And I'm inviting you to go study Al Brooks stuff too. Go in everybody else's stuff. Prior to 1996, okay, you are never, ever, ever going to find anybody talking about what I'm talking about today. These are all concepts that I codified and were in complete form in 1996. Between 1992, November 5th of 1992, on a Thursday at 9 p.m., when I first started my soiree into trading officially, At 14, I was being indoctrinated by my uncle to start looking at the markets, but I wasn't that interested in it. But 1992, November 5th, Thursday evening, at my aunt and uncle's house, who I was paying room and board to live with at the time, I started studying price and starting the process of being a trader. And I began my asset class study of the commodity market. And I rushed into trading with real money before I knew what I was doing. But the lesson I learned initially started this insatiable appetite to master the understanding of what price would do. And over a long period of trial and error, prayer, I have been gifted the ability to see certain things in price action and create a language where you can see these things that are occurring. And it's not buying and selling pressure. So my opinion is this. Okay, I'm getting real close to the things that the powers that be don't want you to know, where everything is so precise. It slaps it in the face when people run around and say we have a free market. We don't have a free market. And that shouldn't be scary. I'm thankful that we don't have a free market. I'm thankful that it's manipulated. I'm thankful that it's controlled, that it's rigged, because that gives you an advantage. Now, the average person on the street, they will never believe that there's an algorithm controlling price. They'll never control the delivery of price right to the tick. There's no way they can do that. That's what they'll say. Because the idea of doing that makes them feel vulnerable, and their systems aren't the real reasons why price goes up and down then. That means it shatters their paradigm. So it's a comfort bubble they stay in by saying, no, there's no algorithm. No, there's no market makers controlling price. And they'll say market makers are just trying to be delta neutral. No, that's a dealer. And that's why they've been named inappropriately market makers. You're not making a market as a dealer. You're dealing in the same price feed that everybody else is dealing in. You're trading in the same thing that I'm trading in. Everybody's using the same price feed. Futures has the same price. The high and the low and open and close, everybody has that, but you don't have that in Forex. Every broker has its own individual high and low, its open and close, and that's why you're losing money. I left Forex for a reason. It's getting dirty in it. In Forex, you're not going to see these pristine deliveries as you see in futures. Futures is a gentleman's market. Forex was the Wild Wild West. There was a time when it was great, but there's things shifting globally, and it's all going to be currency based. I don't want to be a part of that. So I have steered my focus away from them. And notice how I don't know how to explain it other than just consolidating, rangy. It's really not trying to do anything, as eventful as index futures has and commodities has. And this was my first love. This is where I first learned how to trade, in the commodity market. And I moved away from things like orange juice, which was my first traded market, and then moved away from live cattle, feeder cattle, pork bellies, all these markets that were agricultural in nature. And then I moved to currency futures, and then the bond futures. And then eventually I said, well, I'm going to start trading in the S&P 500. And then I realized that there are things that I can capitalize on that keep repeating over and over and over again. And having an insight like these little surgical strikes in the price action, where you can measure its effectiveness and anticipate its formation. See, that's the thing I want you to understand, that Monday's first presented fair value gap, when I told that in a live presentation on Twitter, it was a space on Twitter, meaning I just talked for hours. I tuck these little secrets inside of long-winded discussions because I don't want to give it to the lazy people. The lazy people, they rebrand it and they make mentorships. And they talk about things in hindsight. They can never go out here in front of you live and explain beforehand with accuracy and clarity what they're supposed to know. There's a lot of ICT quote-unquote mentors out there right now, and none of them, listen to me, none of them are qualified to teach what I'm teaching you. They don't have every aspect understood. They just are familiar with it. They're demonstrating how they use it, but they don't know what makes these things work. They don't know where they're going to form. I do. I've said many times, even back on baby pips, I know where the high and low is going to form. I know where the high and low is going to form on the weekly chart before it trades there. And because I know those things, that's a level of responsibility that I have to guard. Because can you imagine the information in the wrong hands with people? I mean, look what they've done already with my lectures. They prostituted them. They call them institutional candles. There is no institutional candle. Okay, FU candle. All these little renamings. Okay, of my order block. And my order block is nothing like supply and demand. There's so many very specific things that you have yet to learn about that literally gives such an advantage. It's laughable. Imagine a harmonic trader. Imagine an Elliott wave trader. Imagine a Wyckoff trader. Okay. Imagine a volume profile trader, a VWAP trader. You don't know where VWAP's going to be at 8:50 a.m. to 9:10. You don't know that. No one's going to know where the harmonic pattern is going to be at next week. I know where the highs and lows are going to be next month, next year. I know that. But I don't want you thinking that I'm ever going to teach that in these books. I'm never teaching that in these books. Those things are mine. They're codified by me. You're never going to get that type of information. But I'm demonstrating very basic. This is all basic stuff. It may seem complicated and complex to you, but I taught this first presented fair value gap last year in a Twitter space. And 90% of you probably never cared enough to do any back testing on it because you didn't see me doing it in a little vignette where I recorded a trade based on it and drew attention to it. But a lot of my trades are based on those types of things. Just because I don't have it annotated in the chart, like you're seeing it right here, where it literally calls the high of the day, that was the basis for me using 600, 20,600. If it goes above that, it's traded above that Monday's first presented fair value gap. If it's going to go above that, then it's going to treat that gap as an inversion fair value gap, which would be the springboard up into the liquidity above Tuesday's high and the 20,680 level. But because it didn't go there, our focus was to look for shorts right from the jump street at opening bell and trade lower into the gap here and then into consequent encroachment of the opening range gap, which is down here. So that's a lot of range, isn't it? And you can see my exit. Look right here. They'll see a little sideways caret symbol. It shows you the actual exit point right there. You see it? I'll keep flashing it. There you go. I'm exiting as it's trading into that. Okay, I'm sliding into home. And I went back to helping my wife. So I want you to think about how my concepts are literally light years ahead of everything else. And there's a lot of opposition to that right now. There's a lot of people that are trying to get your attention because they're trying to sell $200 courses while they're resetting 900 funded account combines. There are people out there trying to teach other concepts that are archaic and don't have any bearing on why price goes up and down. They have no idea how to tell you what time a setup's going to form. I know. I prove it. I know when my setups are going to form. Contrast that with anything and everything else. You don't know. You don't know that. No other school of thought teaches that. I know where fair value gaps are going to form before they form. I've proven it in live stream. I've literally called out fair value gaps before they actually formed. Come on now. I mean, it seems like magic, okay? It seems like sleight of hand, and there has to be some kind of fraud to it, right? But there isn't. It's just the truth. And I'm proving it over 1 minute and 15-second charts. And no one can come close to this. No one. And this isn't even my best stuff. Like, none of this is even high order stuff. This is the easy stuff. It's laughable when you see these people out there say that my concepts don't work or price trades through the fair value gaps. It doesn't even work. You have no idea what you're doing with them. You have no idea. Look at the first volume imbalance right here. Look at that. And then the second one formed here. I drew those out in live stream. I told you to look at that midpoint right there. And they would trade up to that and then trade lower. And I wanted to see it trade down here because then I would have said, okay, I would expect it to trade from that point up to first presented fair value gap on Monday, which is that blue box. But you're not seeing that drop down there. And I'm not interested in chasing anything going up here because I know that if we get here, it needs to then either breach 20,600. And then if it does that, it's going to come back down and use this as an inversion fair value gap. And that would use that as a Judas swing during the opening range of 9:30 to 10 o'clock. And it would rally up first to get this liquidity and then tank. These are all the narratives I outlined yesterday. And I made a very strong point about how someone that is just an idiot or just wants to troll, because they know that your attention span and most other people's attention span is very, very narrow and small. And that's not a knock against your intelligence. It's just the fact that that's what social media has done. It's bred short-term attention span. So if there is a scientific, or a technical element to something, it's very easily lost on the train of thought of most people online because they want something easy. They don't want to have to worry about critical thinking. They don't want to worry about any effort in trying to study or backtest the principle. They just want to give me something I can do right now. Show me a magic trick that I can go out there and teach my friends that I'm special. That's the equivalent of most people coming into the trading community today. They want to be able to impress their friends and family and look smart and look like they're rich when they don't have any money. So when I am showcasing these things and explaining them, it's the number one proof conceptually they are real. They're not contrived. They're not just conjectures. They're absolute principles, and they're aspects of delivery. Well, look at the return back into this area here, which was the gap I outlined in the morning session on the live stream over here, where I was telling you about the volume imbalances, encapsulate all that for your fair value gap. Look what it does here. It comes all the way back up, trades into it here. What time of day is that? It's the 9:50 to 10:10 macro. And then price displaces, trades the sell side back down to the lower quadrant of the opening range gap. What is this? Right here. When it trades back into first presented fair value gap, which is this candlestick right there. There is no gap prior to, 9:30. This, we can't use that for first presented fair value gap. So you got to use the next one, which is here. So that is your first presented fair value gap using the volume imbalance. So it's trading up into that beautifully and stopping right inside that upper volume imbalance I showed in the live stream yesterday. Trades to its consequent encroachment and the upper half of the first presented fair value gap and breaks down. But the bodies are respecting what? The halfway point of that first presented fair value gap. What time of day is it occurring? What time is that? 2 minutes after 12. So that is what? 11:50 to 12:10 macro. Then you have the market deliver down. When it trades to here, it gets to consequent encroachment of the opening range gap. It consolidates. This is time distortion. All of this right here is time distortion until we get to what time of day is becoming influential again? 1:30 to 2 o'clock. That's your opening range for the PM session. So you would look at it like this. I've said all these. I've taught this already. Listen to last week's lectures. Listen to every lecture, really. But I teach these principles so that way you can go and look for it. Okay? The market trades up into the gap I mentioned this yesterday morning. Trades right up into it, fails to get the consequent encroachment, and displaces lower. Institutional order flow entry drill right there. Breaks lower. Trades back down into lower quadrant of the opening range gap. That's that blue line here. Consolidates. Volume imbalance there. Sell side drops down. Relative equal lows. And in Asia, later on, because all this is time distortion. And then finally, in Asia, at 8:14, we break lower and trade to a full gap closure down here with that black line. And then where we're at right now is here, going right back to yesterday's first presented fair value gap. See that? So my focus is still up here. That's what I'm looking for. I'm looking for reasons to justify why it goes there. Okay? So I will wish you all a very pleasant day. Be safe and enjoy your weekend.